Hello everyone, I'm Bob Landaas. Welcome to the Fall 2020 Landaas Company Investment Seminar. Because of the pandemic, we've made the decision not to have an in-person seminar this year. Hopefully we'll see everybody face to face 12 months from now. What a year it's been. Testing the nerves of almost all investors. Our goal for this seminar is to talk about possible and probable outcomes for the stock markets and the fixed income markets here in the United States and around the world. Joining me on the seminar will be Kyle Tedding, Head of Research here at Landaas Company, along with Brian Kilb, Dave Sandstrom, Steve Giles, and Art Rothschild. Joining me now is Kyle Tedding. Welcome, Kyle.
My pleasure, Bob. It's wonderful to be able to put this back on, even if it's in a little bit of a different form this year.
Kyle, as you know, one of the most often asked questions that we get at the firm is, why is the stock market basically recovered when the economy is not? It's hard to ignore the efforts of the Federal Reserve and the U.S. Congress and the stimulus and the bond buying program. During the financial crisis, the federal government spent the equivalent of 1.5% of GDP to turn things around. Now the government spent almost 4.5% of GDP to stimulate. I learned years and years and years ago not to fight the Fed, that if the Fed is trying to stimulate, don't fight what they're doing.
You know, I think that's such an important point, Bob, that you look at the Federal Reserve, you look at the federal government more broadly and the impact that they can have on markets, especially in the short term, to support things. And you know, I think it's clear that that's been a big piece. I think, you know, as you and I have talked about, maybe it goes a little bit further than just the Fed.
Kyle, the second most asked question, or maybe even tied for first place, is efforts to time the market. It's amazing how many clients I've been talking to recently that say, you know, things look really crazy out there. Why don't we just sell and get back in when things look brighter? You and I both know that market timing is almost impossible to pull off. Getting out's the easy part. You just have to hit a couple of computer keystrokes. The hard part, of course, is getting back in. For the average investor, they wait for the skies to clear, the sun to come out, and then you pay the price, of course, with higher stock prices.
You know, of course, Bob, we often don't know what the bottom is until it's far too late to call it. And so, you know, you look at this latest market fall over the span of really about 2 weeks, we went from a market peak back to a market bottom. And I think few at the time thought that that was going to be it. And so, you know, it would be great for investors if there was somebody out there who could say with certainty that they know the tops and the bottoms. The reality is we just don't see that.
A lot of short-term uncertainty, of course, because of the elections. Pandemic has been getting worse in a number of states here in the U.S. As well as Europe and in Asia. So a lot of uncertainty out there. You know, the challenge with market timing is to be real clear on what drives stock prices. And usually, as in politics, it's typically earnings and interest rates. And I think it's reassuring to know that we're expected widely to get back to the earnings that we saw for the S&P last year sometime this coming year. As you know, the S&P earned $163 last year, excluding negatives. I think next year, give or take, we could hit $166.
You know, I think the challenge for investors is looking beyond the current uncertainty, right? That if investors looking at stocks should be concerned about what's to come and not what has happened. And right now, as we look at earnings, we're in the middle of what has happened and not maybe focus so much on the what's to come. And so encouraging to see the forecast for earnings growth, encouraging to see that we should be getting back to some semblance of normal, especially if we can get a vaccine out there. And I think that helps boost stocks a little bit higher.
Kyle, the behavioral psychologist, will talk about the vagal nerve. It's a fight or flight response that the human body has. In the 46 years that I've been managing money professionally, I've been in awe of that because, frankly, when the average individual faces danger, you want to do something about it. You're either going to fight it or you're going to run from it. And I think one of the best things we can do for people during times of crises and uncertainty is to encourage people to think longer term, get past November, get past next year, look out into the horizon. Stocks inevitably recover. bear markets can be over in a short period of time. That can last a number of years, but you don't want to be acting like you need all your money tomorrow. You don't. You need it to last the rest of your life. So it's a natural response that the human body has when it's faced with danger. But for most folks, the best response is to sit on your hands and not do anything. It's so easy to trade nowadays, and market timing is so tempting. Very disappointed to see a study that Fidelity came out with that showed that 30% of their retirement accounts, people left stocks in March, and they impaired their portfolios because, of course, they missed out on the recovery.
You know, I think what we have seen is that flight is almost never the right response to market volatility. It's almost never the right response to the fear that comes with that. And the reality is, I think our job is to give investors the tools to be able to stick it out and to talk about what the right portfolio looks like in order to be able to do that, right? To make sure that, yeah, you might get a little beat up as the market bounces around, but we want to give you the tools to live to fight another day. And so, I think the way that we talk about investing portfolios that we've done in this studio for years, that you've done at the seminar for years, I think it's such a critical piece of how we as investors should be responding to that fight or flight response.
Well, simply explained, emotions are not an investment policy. You may think it's the right thing to do, but in almost all cases, as I said, getting out's the easy part, getting back in, it's hard, because if you were leaving the markets because of fear, it's very unlikely you're going to get back in when things are still unsettled. And it's amazing how many people that I've talked to that are positive that the market's going to come down later this fall. In the 46 years that I've been doing this, I've never been positive. I've always been second guessing myself. I always try to create hedges. I always try to create balance, because you never know for positive where the markets are going.
You know, I think that word positive is really the key, right? That if you're drop dead certain that something's going to happen, of course you'd take action. The reality is we're very rarely drop dead certain about especially things related to investments. But what we do know is that longer term markets tend to rise. What we do know is that markets tend to rise in line with earnings. And so if we put together the idea of what earnings are going to look like a year from now, 2 years from now, well into the future, and start to have a conversation about how we get there, then perhaps we're a little more optimistic about stocks than what you'd be if all you're doing is looking at what you expect to happen in November.
Kyle, short term, we saw a pretty good correction on the NASDAQ in September, down more than 10%. Seems that the economic indicators are showing that the economy is softening again. Once that stimulus money ran out, the $600 unemployment checks at the end of July wasn't a mystery. Retail sales started softening right after that, along with a host of other indicators. And now Congress still, to this date, have been unable to launch additional stimulus at a time when over 12 million people are still out of work. So we've run into somewhat of a soft patch here. Hopefully Congress will come up with some kind of additional stimulus, which is critically necessary at this point for the stock market. Of all the indicators that I'm looking at, I think job creation is the most important right now, because without additional stimulus, we're going to see softening in the leading indicators. And what we need now is to get people back to work, so when the vaccine arrives, we quickly get back to normal.
And of course, the challenge is that in the span of weeks, we saw 22 million jobs simply vanish because businesses shut down, because we weren't sure what the future would look like. And you move forward to now a recovery where, as of August, we've seen about 10 million of those jobs come back. But the reality, if you look at what the Federal Reserve has said, if you look at what any number of economic think tanks have said, is that some of those jobs aren't going to come back. And so I think the labor market continues to be the key piece that we look at, because it's such an important piece of our economy, because it's such an important piece of what we do. It's why the Fed's response was so important. It's why the federal government's response was so important. And it's why where we go from here is such a critical piece of how the economy recovers. Ultimately, we're optimistic about stocks, as we've said. Ultimately, we're optimistic about the path forward. But we need to see some support for the economy from various aspects in order to be able to take that next step.
Kyle, I've lived through all sorts of recessions over the years, and we have run into the same dilemma every time. When earnings collapse in a recession, forward multiples, forward PEs in the market show a market that's pretty expensive. Now the problem, of course, with forward PEs is they arbitrarily cut it off at 12 months, and yet the normal economic recovery out of a recession takes 2 or 3 years. So having said that, you look at the forward PE for the S&P 500 right now, a little over 20%, a little bit on the pricey side compared to the 15 and 20-year average. But it's encouraging to see that the PEs have come down a tad, and that we have this new environment with rock bottom interest rates. And when you look at the 10-year Treasury now at roughly 2/3%, it changes valuation models when you use a much lower interest rate, as you know, to discount future cash flow back to present value. You come up with companies that are worth more. And then the point is the companies that have higher cash flow get the shot in the arm and they're worth even more because we're discounting future cash flow by a lower number.
And of course, it's all about earnings and interest rates, as we're fond of saying. And I think the earnings piece, just going back to what you mentioned on the fact that we only look at the next 12 months, some of the research we've done here in-house has looked at 2-year earnings numbers, has looked at further out, what's an average PE look like for the market. And yes, we're 20 to 25% overvalued relative to the average PE on a 1-year basis. That number's cut in half if you look at earnings over the next 2 years or earnings forecasts over the next 2 years. That number looks even better as you start to project out to what earnings could look like down the road. And so I think I'm a little more optimistic about valuations when you add in the fact that you've got earnings coming back. And then the second piece of that, as you mentioned, is the direction that interest rates are headed. And we have seen interest rates now at record lows for a long time, likely to continue there for a while the way the Fed is talking. And so that's very supportive of multiples far higher than what we would typically see in these environments.
Kyle, when I say that the S&P 500 is trading now at a little over 20 times 12-month forward earnings, it really hides what's actually going on within the markets. If you look at the growth stocks, they're trading at roughly 28 times 12-month forward earnings, while the value stocks are trading at 16 times forward earnings. That 12 percentage point gap is triple what is normally the gap between value and growth, 4 percentage points. Market strategists for years have been suggesting that value stocks are going to be coming back anytime soon. My sense of the markets is that growth stocks are still going to enjoy a pretty good tailwind for a while. It's important to remember that value stocks, typically the financials and the industrials, need above average economic growth to really get them going. In the average recovery from a recession, value stocks do better because you get growth as a given. You don't need to overpay for growth with growth stocks, but this time it's really different. So much of attention has been paid to the 5 stocks that are dominating the markets now. Apple alone accounts for almost half of the earnings that we've seen for the market, and those 5 stocks, are now 24%. So Apple, Amazon, Microsoft, Google, and Facebook, now 24% of the market, over half of the earnings. They didn't miss a beat, it seems, with the virus. Their cash flow was uninterrupted. Data mining, of course, their dirty little secret of cash flow, uninterrupted to a lesser extent. Acceleration of e-commerce. I never bought groceries online until March, that kind of thing. So the growth stocks still seem to have a tailwind, but at the time when we see a pretty good acceleration in economic growth, I think the baton eventually, inevitably, will get passed to the financials and the industrials, perhaps even the materials. But it's important for people to be patient in the value space. There's some bargains there. There are probably going to stay some bargains. And then, of course, the challenge is to find companies that have reversible demand versus companies that have been permanently impaired, perhaps bricks and mortar retail, business travel, and the like that may not come back.
I think this growth versus value debate is one that we've had now, it seems like, for years. And what's interesting to me about the transition from maybe value stocks a decade or two ago to value stocks today is that they tend not to be some of the household names they used to be. It's the growth stocks that we seem to be hearing quoted more often now. You talked about Apple and Microsoft and Facebook. Those are the businesses that everybody knows. A lot of the value stocks are some of the businesses that maybe you aren't interacting with as much anymore. And so, I think just from a pure name recognition standpoint, there's a lot of reasons why investors have flocked to those businesses they know on the growth side of the market. And then you look at the longer term trends that have supported our economy, things like work from home, especially recently, things like data storage, things like cloud computing, things like, as you mentioned, e-commerce. Those are all growth-based businesses. They're businesses where, a company like ours that had dabbled our toe in working remotely, all of a sudden in March we're forced into Zoom calls and Zoom meetings once a week. We were forced into doing more work remotely, and that requires new subscriptions we didn't pay for before. It requires a new technology that we hadn't really had to explore much before. And so, there was some element of some growth that was realized up front for those businesses, but there's also a realization now that there's a real path forward for a lot of those names, for a lot of those growth businesses that we didn't talk about. And then the last piece of this is that I think value stocks have some things that growth stocks don't have, in particular within the very name, right? This idea that they're a little bit cheaper. Yeah, you got to be careful that you're not buying things that are going to stay cheap. The value trap, as we like to call it. But there is a benefit to buying things that are trading at a discount. And then, of course, you have the opportunity for income from a lot of these value stocks. And so, I think a number of investors attracted to the idea of a dividend, a number of investors attracted to the idea of buying something at a discount. It's going to take a little bit to get there, and certainly the economy isn't supporting value the way it should right now, or perhaps the way we need it to right now. But longer term, you buy something that is going to be more expensive later on. If you can buy it at a discount, you're doing a great job.
One of the problems with a lot of value funds, of course, is they own large percentages of oil and gas stocks. Oil and gas plunged down to roughly $40 a barrel. It's unlikely demand is going to pick up anytime soon. Break even for a lot of frackers is a whole lot higher than $40. So you're going to see continued bankruptcies, in my opinion, in the oil and gas fields. And as a result, their stocks are probably going to be underappreciated, if you will, for the foreseeable future. So the point is, I think it's important to differentiate between different areas in the value space. I favor at this point in time bank stocks, although the spread is so small, and the industrials. Kyle, let's talk for a minute about the huge gap in performance between small company stocks and large company stocks. I mean, not only has growth dominated the marketplace, but so has large company stocks. Historically, small companies do pretty good coming out of a downturn. Perhaps it's still a little early to call that. But for a number of years now, investors have favored the large caps at the expense of the small caps, and the gaps in valuation now is fairly extreme, and some studies show that small caps are the cheapest they've been in decades.
We have a structural issue in small cap stocks that often isn't discussed, and that is that there just aren't as many stocks out there as there used to be. And so one of the problems we're seeing is that a lot of the best businesses, or a lot of the up-and-coming businesses, they don't go to the public market until they're much larger businesses. And so a lot of the past studies, or studies looking at past returns, looked at some really great companies that started out as small businesses. They grew into these mammoths, and investors benefited from that. And so one of the challenges we have in small cap stocks, and that we've had really for the last 10 or 20 years, is that some of the best businesses didn't go that route. They were either bought up by larger businesses, which have supported the returns of those larger businesses, or they stayed private a little bit longer before they became those public businesses. And so that's been a big headwind to the return of small cap stocks. Now the challenge is, at some point in time, some of those more mature small businesses look so cheap that you have an opportunity there that didn't exist before. And so, we may be entering an environment in which you can add a little bit of a piece of your portfolio to some of those medium and small size companies, doing it in the right ways, in the right places, but understanding that what you're getting maybe isn't the high octane growth you used to get from some of those smaller names, but you're getting a little bit more of a deal than you could get before.
I read recently that Apple Computer is now worth more than the total value of all small cap stocks publicly traded here in the United States, just one company.
Yeah, such a good point. And I think, it gets back to this idea that some of these big businesses, they're such a big piece of our economy, they're such a big piece of how the markets function that often they're the ones that are financing a lot of those smaller businesses to begin with, because they're the ones with cash, they're the ones with an interest in those businesses really becoming, a big deal. And so I think you look at Apple as kind of the major player, but there's others with plenty of cash, there's others with plenty of interest in developing some of those smaller companies. And again, maybe that's another reason why there's some opportunity there.
Kyle, the U.S. dollar has been strong, as you would imagine, during the pandemic, making it a little bit more challenging to make money overseas. Growth stocks have made more than value the last 10 years. U.S. stocks have made way more than international stocks the last 10 years, as well as way more than the emerging market stocks. So you look at some of the valuations, stocks are quite a bit less expensive in Europe as well as Japan. Warren Buffett just recently made a huge investment, billions of dollars in Japan. So, at some point in time, I think the markets are going to start tilting overseas. A couple of the problems that I see, one, of course, is that Brazil and India, two of the largest emerging markets in the world, are now leading the world in virus positive tests as well as deaths. That's a problem. So I think moving forward for the emerging markets, I think you've got to be connected to East Asia and China at some point in time. But the valuations are such that dollar starts to weaken at some point. And again, we've been saying this for a while now, that eventually the dollar has to weaken. And I think there could be some attractive offerings overseas.
And I think the one challenge that we have to understand is that there are some reasons why non-U.S. stocks are cheaper. That when you look at some of the more expensive stocks here in the U.S., they represent technology names, they represent those growth names that we've talked about, and that's a far bigger piece of the puzzle here in the U.S. than it is in much of the rest of the world. And so there are reasons why we'd be a little bit more willing to pay up for U.S. stocks than non-U.S. stocks. And so the question is the gap between U.S. stocks and non-U.S. stocks at a point where non-U.S. are a little more attractive? And I think the answer probably is yes. You've got to be careful, obviously, where you go there. I think what we've learned over the years as investors is that when you leave the well-understood areas of the world, it becomes incredibly important to team with people who really understand what it is they're doing. We have this debate between active management and passive management. What we've seen is that an understanding of those companies involves more than just investing in some global index. And so, as we look at the opportunity set, I think it's going to be incredibly important to be very picky about which of those things you go after, and not simply saying, non-U.S. as a whole is attractive.
Kyle, U.S. interest rates plunged in March as the U.S. government and the Federal Reserve struggled to come up with an effective response to the collapse of the economy. As a result, they pushed interest rates to extremely low levels. The Fed Chair Jay Powell recently said they're not going to raise rates for probably 3 years or more. That's an eternity for what we do for a living. And as a result, bond investors have enjoyed outsized returns. Many bond funds have performed in the 6, 7, 8% or even more range. And investors in those types of securities have now seen returns that would normally take 2 years or more to gather.
And of course, those are returns in high quality bond funds. I think often, you hear high single digit returns on a bond fund and you immediately think risk. But what we've actually seen is that some of the intermediate term, higher quality offerings that we like to look at are doing better than many of the stock funds we look at, especially if you're looking at, just traditional middle of the road stock funds. And to get those kinds of returns on bonds only comes because of what the Fed has done. They've changed their language about how they're going to view future interest rate moves. They've changed their language on what's important to them. And I think that suggests that maybe interest rates can remain a little bit lower for a while. And so you look at that and go, okay, that supports higher stock valuations as we've talked about, but it also means that maybe the easy returns on bonds are over. And so, I think it gets back to the question of if the easy returns on bonds are over, what's left for bonds? And I think it gets to the most important piece of why you have them in your portfolio.
The U.S. 10-year break-even suggests inflation at 1.6% for the next 10 years. Kyle, that's a pretty low number. I think for all intents and purposes, it's fair to suggest that inflation is not a threat moving forward, at least for the near term.
Yeah, I think we have, for the last 10 years, heard clients come into the office and tell us, what are we going to do if inflation pops up? Because they're hearing in the popular press, they're hearing from people who want to sell them something, that inflation is a significant concern. And I think the reality of what we've seen over the last 10 years, inflation was next to non-existent, right? That you saw it briefly get back to the Fed's 2% target and then fall down below it again. We've seen what the Fed has talked about in terms of their targets for inflation going forward. Those are not signs that inflation is going to rear its ugly head anytime soon. And so, the typical tools for inflation that so many people are looking for, whether it's to hide out in non-U.S., whether it's to buy Treasury inflation protected securities, I don't think they necessarily offer the inflation safety that so many people are looking for. Now, you may get some safety from Treasuries more broadly, you may get some protection from those fears that you have, but if they don't materialize, maybe it wasn't a worthwhile investment. And so I think it's going to be interesting to keep an eye on where it heads, but more importantly, if you read the writing on the wall, if you listen to what the Fed is saying, it's not a concern they have anytime soon.
Kyle, as you know, as interest rates get to rock bottom levels, duration risk becomes more of an issue. Of course, what we're talking about here is when you have a low coupon on your bond and interest rates at some point in time go up, you don't have much of a coupon to subsidize the hit you're going to take to that bond. You and I have stuck to, for the most part, 4.5, 5-year average durations. Although it's tempting to go out further for perhaps a little bit of a higher coupon, not worth the risk at this point in time, in my opinion.
And let's be honest, on duration risk, it maybe isn't the primary concern we should have with our bond funds. First and foremost, we look at credit quality, and we make sure that what we're having is going to be a higher quality, safer piece of fixed income to hold in our portfolio. And so, that's the place I always look first. But to get to the duration point directly, I think when you add in the fact that the Fed is talking about keeping rates lower for longer, when you add in that inflation maybe isn't the concern that so many feared, yes, rates can move higher, especially because we're talking about an environment in which they're very low. But how high can they go from here if the Fed's going to keep some kind of cap on that? And more importantly, if inflation isn't a concern, how high do they need to go? And so I think, we look at duration, we do the simple math on, well, if interest rates move 1% higher and we've got a portfolio with a 4-year duration, that's a 4% decline in our bonds. But the reality is, what's the likelihood that we see a 1% move in the portfolio or a 1% move in interest rates? And then I think more importantly, it gets back to why do we hold bonds in the first place? We're not holding them because we think they're going to be a significant portion of the long-term return. We hold them because if the biggest move we see is a 4% decline or a 5% decline in an environment in which rates are moving much higher, that's a short-term hit. Ultimately, those higher rates are going to come back into the portfolio in the form of income. And yeah, for that 1 year in which rates moved higher, you might take a little bit of a hit, but over time, those higher rates support a far higher return on bonds than what we're seeing today.
Kyle, over the last 10 years, bonds made almost as much as stocks for investors here in the United States. My guess over the next 10 years, with interest rates at rock bottom levels, the stock should make quite a bit more than bonds. So I think it's important for clients to be flexible with their asset allocation strategies. In some cases, investors may be willing to go to a dividend that could pay a little bit more than a bond would. Of course, you're increasing volatility in your account, you're increasing the risk, but for income investors, that could be tempting down the road.
And I think it's so important that we give investors the tools they need to stick it out when portfolio volatility occurs. That you can't be running for the hills every time. You can't be running out of the portfolio every time markets sell off a little bit. And so the lower earning fixed income piece, even if bonds aren't earning all that much, is an important piece of the puzzle because it gives us the courage to stick around. But as you say, the stock piece is the piece that over the next 10, 15, 20 years is going to be the piece that contributes to earnings. more than likely more than what we saw in the last 10 years. And the other piece of that is that it also means that we probably have to look for new ways to diversify. We were very U.S. centric over the last 10 years, and that worked out very well because U.S. stocks did far better than non-U.S. stocks. But I think that as stocks become an increasingly important piece of a portfolio, we have to be more broad in the way we think about allocating to them, whether that's looking more to non-U.S. stocks, whether it's looking to maybe some non-traditional stock sectors like real estate. Those are pieces of a portfolio that ultimately look a little different than stocks alone look and can add to the benefits of a diversified portfolio.
Kyle, one of the lessons we learned during the financial crisis is that when correlation goes up amongst various asset classes, you got a problem structurally in the markets. I bring this up because, as you know, recently correlation has been increasing across various asset classes, typically not a good sign.
And obviously, I think the Fed's interaction in the bond market has driven some of that. That if you have a Fed that's suppressing rates intentionally, right, to try to stimulate growth, that pushes bond prices higher, that stocks tend to rally because they see what the Fed is doing and they're encouraged by it. And so you can see correlations move a little bit closer together in short-term environments. I think where we really get concerned is when that correlation persists. And so that's something that you and I know certainly will be keeping a close eye on. But I think more importantly, it just continues to drive home the point that you've got to be safe in the things that are safe in your portfolio. You've got to look beyond simple indexes to investment ideas that maybe are trying to minimize risk in what they do beyond simply saying this is a stock portfolio. And so, as we construct portfolios, we're looking for stock managers who talk about how they manage risk. As we look at opportunity sets, we're looking at opportunity sets that maybe aren't that one-to-one correlation that we've seen between stocks and bonds right now. And ultimately, again, I think that focus on the long term helps to navigate some of that risk. But certainly, as you say, short term, that's going to be something to keep our eye on pretty closely.
Thank you, Kyle.
Thank you, Bob.
Joining us now is the advisor, Dave Sandstrom, to talk about asset allocation. Dave, when I started managing money in the mid-'70s, it was widely viewed that Wall Street added value through market timing and stock selection. 1986, a famous study came out, the Brinson B. Bauer Hood study, that showed, well, maybe it's more asset allocation than market timing and stock selection. And then, of course, 1990, Harry Markowitz, work he did at the University of Chicago, led to the Nobel Prize in Economics for his theory of asset allocation. Of course, Dave, it wouldn't be a seminar without us talking about our well-known 30-year look-back chart of asset allocation. Would you please step the viewers through that latest version?
Sure thing, Bob. The efficient frontier chart that we have on the screen now is really basically a risk-return trade-off chart. And, we embrace risk. We like risk. We need risk to make adequate returns. But we also need to know for every additional unit of risk that we're taking, how much is that return? Am I getting compensated appropriately for that extra unit of risk? And as the chart shows here, you can see as you move up off of a 100% bond portfolio and you pick up a 20% sleeve of stocks, you see a nice bump in return, yet we're not looking at a large increase in our risk. And that kind of continues across the curve. You look at 40% stocks, another nice bump in return. And then as we move out, though, you'll see something interesting happen. Once we get to about 60% in stocks, we see now that our risk line is going to continue to go up, and yet our return line is flattening out. And if you look here at the numbers in the chart, you can see that 60-40 portfolio for the last 30 years returned 8.9%. The 100% stock portfolio returned 9.8%. Now that is less than a percentage point, and yet you had to increase the risk in the portfolio by nearly 60%. And Bob, I think that you can see from that that's an awful lot to pay for such a small percentage of return. One of the things that we have to look at when we're looking at these efficient portfolios is how the assets in those portfolios react to each other. Something that we talk about with that is correlation.
Yeah, Dave, the correlation theory is fairly easy to explain. It's how different types of assets move relative to one another. If one zigs, you want something else to zag so that in aggregate, the portfolio is doing pretty well. Correlation theory, of course, changes over time. In financial crises, correlation moves closer to one. Asset prices move together, they go up together, down together. But in normal market years, correlation can add a huge degree of safety if you study asset allocation. You know, to me, asset allocation is like the old game of pickup sticks. When you put that one more stick on the pile, when will it all come cascading lower? So you literally analyze at what point is the next unit of risk not worth the reward that you get. If you dramatically increase volatility for a puny increase in return, it's clearly not worth the effort.
And some of those assets, Bob, that we like to place into the portfolio are ones that are negatively correlated to the stock market. Not too many of them out there, but you can see something like treasury bonds or even investment grade corporates have a tendency to do well in times of market duress. And having some of those in the portfolio not only limit the total downside risk that you have during these types of sell-offs, but it also provides you with an important source of liquidity during market turmoil where those assets are going up instead of down. And of course, we never want to sell our life savings at a discount.
You know, and that's really the key to understanding asset allocation is to learn to love your underperformers. The definition of asset allocation, of course, is going to be you'll have some asset categories in your account that are doing better than others. And oftentimes the tendency is to want more of what's doing better and less of what's underperforming. When in fact, if you stick to the asset allocation model, you'll eventually find that the underperformers eventually graduate to lead the markets higher. So it's important to just stay with it. Most people want to talk to me about market timing and stock selection, and the studies have clearly shown that it represents less than 8% of how well you do. It's measurable, but it's not a big number. So you really focus on asset allocation, and the essence is to make sure that you've got your bases covered so that no matter what plays out in the future, that you have a portfolio that's balanced properly to reflect that.
And Bob, especially during times of prolonged market upside performance. So we've just went through that in 10 years. And then people get tired of seeing those underperformers in the portfolio. You get people saying, why do I own all these bonds? Well, then of course we get to a stage where we see something like what happened recently with the pandemic, and people then understand quite clearly how important it is to hold those negatively correlated assets in their portfolio. And Bob, when you look at that 60-40 portfolio, it plays very well into something that we look at when it comes to withdrawal strategies. One of the things that we employ is something called the 4% rule. And when you look at that 60-40 portfolio containing 40% of things that are not going to be affected by that downturn in the stock market, you've just set yourself up for about 10 years of portfolio withdrawals that you are feeling pretty comfortable about where they're at. So you're absolutely right. When you have to love those underperformers, it can be really accented by times of duress like we've just gone through.
You know, of course, the key to asset allocation is to think long-term. Asset allocation means not to try to time your account. Asset allocation means not to dramatically overweight one particular style over another. That's a challenge these days, as you know, Dave, with growth stocks dramatically outperforming value by pretty wide margins. So it takes a little bit of courage to hang on to those underperforming value stocks. Historically, one of my favorite areas of the market, but it's important to own both. Yes, own value stocks even at a time when they're underperforming, and own your growth stocks. Don't load up on them because market leadership rarely repeats itself for more than a handful of years.
And Bob, I think when, sometimes investors get a little intimidated by the charts and the math and the coefficients of correlation studies. But at the end of the day, I think you can sum it up by saying that, if you take half your money and try to grow it and take the other half and behave yourself, I think you're going to find that you're going to stay out of trouble.
To me, one of the keys to asset allocation, beyond correlation theory and beyond the risk reward ratio, is the concept of humility. Pretty difficult to forecast during the pandemic, challenging, perhaps even impossible short term. So that's to me, the beauty of asset allocation is that your portfolio is designed to take you through thick or thin. Market timing is challenging. Forecasting is almost impossible with so much uncertainty out there. So you can rest assured of knowing that your model should stand the test of time. And of course, the chart that we have shown now, we've been bringing out every year in these seminars for decades. And folks with good memory will know that the results rarely change. There are times when the 30-year pattern leaves out some bad markets, includes good markets, but you're talking about tenths of a percent normally. And I'm just mesmerized by having done this for so many years that the risk reward ratios hardly ever change over time. Well, thank you, Dave, for those words of wisdom.
No problem, Bob. Thank you for having me on.
And now Kyle Tedding, the Director of Research at Landaas Company, will be interviewing Brian Kilb.
I'm here with Brian Kilb, advisor at Landaas Company. Brian, interest rates broadly took a tumble in March amidst the pandemic economy. Now, clearly, lower interest rates are a good thing for borrowers. It helps them afford things a little more easily as, the financing costs are lower. And maybe it's a challenge for savers who see lower rates on, their bank accounts, lower rates on CDs, the things that they typically go to when they need safety. Maybe that's a simplistic view overall of rates, though. I think, as we know, rates have a far broader implication for stocks and a far broader implication for investors more broadly.
Let's talk about the role of interest rates in the stock market. So we have a tendency to make this a very complicated thing, right? It gets very technical at times, but I think it's often highly useful to take things back to a more simplistic view and really look at the essence of what's involved in the stock market. So if you think about the stock market in its most basic sense, what you're doing is buying a share of a company or many companies and focusing on the earnings of that company, right? If your company and the shares you own make money, you're going to get that appropriate share value. Now, it gets a little bit more complicated. If you're buying a future stream of earnings, the dollar that you earn 5 years from now isn't the same or worth the same amount as the dollar that you earn today. So we have to discount the earning stream and put it in a value that makes sense in today's world. And then I think the third thing that matters is valuation, right? If we're all taking some considerable time to speculate about what the future earnings of that company or the market are and discounting it by some sort of discount rate, then there's also some criteria in terms of whether we're willing to pay more or less than we think it's worth for varying reasons. So it's those three elements that bring us together to form the stock market, and interest rates certainly play that key role in the discount side of that equation.
Brian, let's talk about that discount mechanism, because clearly I think for investors, as they look at, again, a stock being a share of future profits, the thing that matters is not as much about what those profits are worth today, but what they're going to be worth in the future. And so a dollar 10 years from now, as we know, isn't worth the same as a dollar today. So, as an investor in the interest rate environment we're in today, maybe tell me a little bit about why it's better for stocks to have lower rates and what that means for discounting.
Well, again, Kyle, as you know, a key concept in the financial world is the time value of money. And of course, I think most people have a sense that that dollar 5 years from now isn't worth what the dollar is today. So let's think for a minute about what the impact is and the difference in interest rates between, say, 2% and 6% in the market. Now, first of all, there's a couple of different ways that we look at a discount rate. The one we most often use is, what would it cost me to borrow money to use to invest? Inflation can play a big role. If costs rise over a period of time, that dollar today isn't going to buy me as much as it might be tomorrow. And then a third thing we might consider from time to time is opportunity cost. What could I get in lieu of this investment for other comparable investments. But the one we focus on most often is interest rates and the cost of money. So go back to the example of 2% versus 6%. If you had $10,000 and discounted it by 2% over 5 years, that number is roughly around $9,000. If it took a 6% discount rate, that number drops to $7,600, give or take. Now, what that means for the market is if I kind of flip that around and say, well, if I want to have 10 grand 5 years from now, under a 2% scenario, I can pay $9,000 for this investment. Under the 6% scenario, I got to pay $7,600 to get that same $10,000 end result 5 years from now. So you can see, Kyle, where the current low interest rate environment allows me to pay more for that investment and reach the same end game.
Yeah, and so I think the idea that stock prices can be supported at a little bit higher level when interest rates are low is supported by that example. And of course, the other challenge here is what our expectations are for rates as we go along. And we know now from conversations we've heard from the Federal Reserve that the expectation is for rates to remain low for a while.
Well, put it in the context of history, if you will, the U.S. Treasury rate around 0.75% right now. Historically, Treasuries might trade in the 4 to 6% range. Now, the Treasury isn't the only rate we can use as a discount standard, right? We could say, well, what about corporate notes? And corporate notes typically are 2% higher. The average on high quality corporate debt right now is around 2% compared to historically 5, 6, 7%. So you can see where the disparity in current rates are relative to history. Now, the problem that creates is when they're as low as they are, it's likely there's only one place to go, which is up. You know, now to your point about the Fed's made some commitment to keeping those rates low for a significant period of time. And so if we look at that horizon and we're looking at earnings over several years down the road, and we can have some assurance that interest rates are going to stay low for a number of years, that gives us some confidence to invest at those higher rates. Now, the other thing I'll say is the worry someday is when interest rates go up, you're going to pay for that, right? Because then that whole mechanism reverses. But if we think a little bit about why rates might go up, it's likely that those similar contributing factors are going to make it possible for earnings to grow up, for earnings to accelerate as well. So while we might be in an interest rate environment somewhere down the road where rates start to rise, it's likely that you always get earnings to rise too, and that may compensate for some of that potential headwind.
I mean, I think investors need to remember that ultimately interest rates typically rise because of economic growth. And economic growth also tends to be supportive of earnings growth. And so, you know, you would assume that if we enter an environment in which rising rates are a challenge, that you have the earnings growth to compensate for that, the headwinds of rising rates. Of course, all investors face opportunity cost when they invest, right? It's not a simple decision of invest in stocks. It's, do I invest in stocks or do I put it somewhere else? And so I think, you know, to bring the conversation full circle, some of this is if we're going to invest in stocks because rates are low, because we expect them to remain low, and that supports higher multiples, it supports higher stock prices than maybe what we'd otherwise see right now. What are we foregoing to do that?
Well, I think you talk about opportunity cost, Kyle, and it's not always what we want, it's what's given to us, right? And the environment we're in right now is a low interest rate environment. So you have to compare what the risks and potentially the impact of lower interest rates on stocks are compared to the other investment vehicles that we have access to. And I think certainly with interest rates as low as they are, if you look at the earnings yield on the stock market and you take the current earnings forecast for next year and you divide it into the present about where we are in the S&P 500, you get an earnings yield of about 5%. Well, again, go back to the Treasury rate of 0.75% or corporate rates of around 2%. It still looks like a pretty attractive deal, right? Now, I think another thing you might say is, well, what about dividends in the stock market, right? It's one thing to pay a certain amount to get a certain valuation in the stock, but if you're getting a 3% dividend or a 2.5% dividend, the volatility and the rise and fall of the price is somewhat secondary to the dividends you're going to get if you keep this thing over a long period of time. So I think not only does the interest rate environment allow for a higher price to pay, higher valuations in the market, but it makes it more attractive from a dividend standpoint as well on stocks when you compare those dividend yields to the yields on corporate bonds.
Brian, thank you so much for your thoughts.
My pleasure, Kyle.
I'd like to turn now to Steve Giles, advisor at Landaas Company, to talk about the earnings piece of earnings and interest rates. Steve, we've said for years that it's all about earnings and interest rates. Obviously, the interest rate piece, the discount mechanism, the way you get from future earnings back to what you're willing to pay for it today. But that leaves the earnings piece as kind of the critical piece for investors and, really the important piece of what it is we as investors are purchasing.
Yeah, that's correct, Kyle. Anytime you buy a stock, you want to ask yourself what kind of earnings you're getting for that stock. Longer term, investors aren't going to buy those stocks unless they know they're going to get a piece of those earnings. Compared to interest rates, which we can all follow the yields on, there are ways to value stocks based upon what their earnings are, discounted out into the future.
And I think the challenge in this environment is the uncertainty, right? That we've seen earnings year over year from 2019 to 2020 fall off a cliff. We saw essentially a disappearance overnight almost in March. And so some of it is more an understanding of earnings being a tool for what we expect in the future and less about what we saw in the past.
That's right, Kyle. We always look at forward operating earnings. We're not so much concerned about where we came from, but where we're headed to. Right now, we've got 12-month forward operating earnings on the market coming in at about 22, but there's a big disconnect between certain sectors. The value forward operating earnings is only 16, where on the growth side, you're getting a forward operating earnings of 28.
Such a big difference there. I think critical to point out, though, that we should be a little bit more willing to pay for growth than we are for value. And of course, the question that we come back to is, has that spread gotten so wide that perhaps there's opportunity in one area or another? But maybe just to highlight why we're so much more willing to pay up for growth, understand that if your interest is in future earnings and the expectation is for earnings growth, you'd be more willing to pay for a growth company than you would for a value company.
And that's what we've seen so far this year, Kyle. A lot of those big growth names that have managed to stay in business and have been somewhat COVID proof as we've lived through 2020. I'm talking specifically about the FANG stocks. These are the Facebooks, the Apples, the Amazons, the Netflix, the Googles of the world. They're all the stocks that have kept us interconnected while we've had to stay home. Amazon, obviously, not missing a beat because we all have to have stuff delivered to our doorstep now. A company like Microsoft and their software keeping us all connected and being able to dial in from home. Netflix, who isn't sitting on the couch on Friday night streaming a movie because they're not going to the theater.
I think you look at uncertainty around future earnings, and the challenge in forecasting is that growth companies become more difficult to forecast down the road because you don't know if that growth will continue forever. And what we've seen in this environment is that the reality is a number of those growth companies have had more stable earnings than what we would have expected. And so encouraged by some of those FANG stocks, encouraged by growth more broadly, and yet, again, I think you go to the other side of that equation and you look at what we're paying for the earnings of value stocks right now, potentially maybe a little bit of a deal there, and the other piece you get is a little bit more stability in terms of forecasting those earnings.
And that's why I like mutual funds, Kyle. I think these fund managers recognize that the growth stocks are going to get to a point where they're a bit overvalued. They have had tailwinds this year, but there will be a migration back into some of those value stocks as professional investors recognize that there's going to be a deal to be had on some of those beaten down value names. Yes, it is frustrating to see the headwinds on some of those value sectors that we traditionally think is more defensive, especially during periods of economic recession. But those defensive names in the bank sector, it's very hard to make money as a bank right now with interest rates as low as they are. Banks make money when the yield curve is steep. We've got a very flat yield curve right now. Look at utilities, look at energy. It didn't help when OPEC and Russia got into a price war earlier, drove oil at one point down to negative $40 a barrel.
it's really hard to recover if you're a utility stock in situations like that.
And certainly with oil as low as it had gotten, earnings are, just about disappeared at that point. And so, thinking through what that means for earnings down the road, oil prices have finally stabilized at what we think is a more sustainable long-term level. But that leaves a lot of disparity between our forecast for earnings, again, not just today, tomorrow, but looking into the future, our forecast for many of these more growth-oriented businesses and, say, some of these value stocks or energy names. And I think then you talk about the opportunity in stocks versus the opportunities that exist elsewhere. And you think through, okay, what are we willing to pay for a stock versus what's the deal that we could get somewhere else?
Yeah, Kyle, it's very difficult to forecast earnings during a recession past 12 months. Right now, obviously, we're coming off a huge trough. Earnings are going to be a little bit elevated, but forecasters think that by the time we get around to next year, the end of 2021, out into 2022, you're looking at 3-year numbers that are a bit more of a return to normal, which I think brings up a very important point for investors to remember, something we call regression to the mean. The only way you're going to get average returns in stocks is to go through periods of obviously above average returns and periods of below average returns. But at the end of the day, they'll all average out and have this regression to the mean.
Steve, we just had a conversation with Brian Kilb regarding the low interest rate environment that we're currently in and interest rates being the discount mechanism for stock. But the obvious corollary there is that interest rates present one possible investment opportunity through bonds. But the other side of that is stocks, and driven by earnings, we have to weigh our options there. And so, as you look at the options that are out there and for investors, what are you finding as far as opportunity?
Well, Kyle, it is true that bonds so far this year have done quite well. There's been a flight to safety. As yields have gone lower, the values of our bonds have gone higher. However, at some point, investors are going to look at those yields in their fixed income investments, whether it's their bond funds, whether it's their CDs, their money markets, or even the savings accounts at their banks, and see that they're not getting much in the way of return. All they have to do is tiptoe over into the stock market and see that the dividend in itself, sometimes 2.5%, is a bit higher than what they might find in their bond accounts. And if they're willing to put up with some day-to-day fluctuation, they're going to get obviously the upside potential that also comes with owning that stock. But take it a step further, Kyle. Every time we look at stocks, we always want to try and compare them to what else is out there. And the big comparison that the pros make is always between interest rates and earnings. But we don't want to look at earnings in terms of their PE ratio. We want to look at the reciprocal of a PE, which is called an earnings yield. PE ratio 22 on the market gives us an earnings yield of about
4.5%.
I don't know how you do math, Kyle, but
4.5%.
an earnings yield is a lot higher than a 0.7% 10-year treasury yield.
Yeah, Steve, I think that's the critical piece for investors to remember is that there are always going to be opportunity costs to investing, that when we look at what you could get in bonds versus what you could get in stocks, the expectation is that long-term returns in stocks will be higher. But of course, you've got to be willing to put up with that stock market volatility.
Well, that earnings yield also, Kyle, gives a degree of support to those stocks. I have a lot of investors that ask me when the market's going to sell off, when are we going to see another pullback? And when we start talking about the earnings yield relative to the interest rates, you start to recognize that because of that earnings yield being so much higher than interest rates, that degree of support lends some tailwind to the market itself.
Thank you very much, Steve.
Thank you, Kyle.
I'd now like to introduce Art Rothschild, an advisor here at Landaas Company. Art and I will be discussing the perils of market timing. Art, investors are driven by fear and greed. It's the defining principle of investing broadly, and yet in the midst of unprecedented uncertainty, I think the fear component often takes precedence for so many investors. It leads us to make decisions that maybe aren't based in rational thought, but rather reactionary emotional thought. The behavioral economist Daniel Kahneman won the Nobel Prize for his studies in essentially the rational response to these types of environments, or the lack of rational response to these types of environments. And so, I think it's perfectly natural for investors to want to know, what should we be doing about this uncertainty? And yet, I think based on our conversations, the answer may be not so much.
Kyle, those are tremendous observations and important points. We can't control the surrounding environment. What we can control is our reactions to those environments. Fortunately, as we know that investing on the basis of emotion is not an investment strategy. Fear and greed are very common human emotions. It may work out in the wilderness if you have a bear chasing you or something, but it doesn't work in the investment field. What we do is we build portfolios, we develop plans, we make sure people stay with those plans. And so that when things that we don't expect happen, we at least have a strategy for managing our money so that we can continue to move forward in the way we expect to move forward with the tools that we expect to use to accomplish long-term goals and objectives without regard to whatever winds might be blowing and potentially blowing us off course.
Oh, and Art, I think that's such an important point, that not only might those winds be blowing us off course, but that those winds are often changing directions. And so if we make the assumption that we know what's coming, if we make the assumption that the decision that we make today in response to something that we think is a certainty is the right decision, it opens us up for some potential mistakes. If we're wrong, right, that potentially we were wrong about this thing that we knew was going to happen. But the second problem, and maybe the more important problem, is what do you do from there?
Yeah, once you make a mistake, you're sunk. We do know, for example, the best example I can think of recently is what just happened with respect to the sell-off. It was the steepest sell-off in history, the quickest bear market in history. No one saw the pandemic coming, but when it came here, it was here. And then the mistakes that people made were thinking it was going to continue forever. That would cause you to sell. You're selling at the bottom if that happens. You're going to lock in those losses. That is one of the biggest investment mistakes anyone can make. So in order to avoid those mistakes, you should just stick with your plan. Those of you who are working with us as your investment advisors, we're here to coach you to try to keep you from making a bad decision based upon your emotions versus the very rational thing to do, which is, quite frankly, to buy at the irrational time. Studies show consistently that the best days for Wall Street are after we've had declines. So you're better off, again, buying at the worst possible time. No one has the strength to do that. So we rather stay in the game and to anticipate the fact that you're going to make money long term if you keep your discipline, keep your faith, and again, stay invested for the long haul.
Art, I think that's such an important point, and you mentioned strategy. I think we talk very much about having a long-term plan and making sure that that plan allows you to stick to it, right? That you don't put yourself in a position where you've overextended into risk. You don't put yourself in a position where you have to respond to the kind of sell-off that we saw earlier this year. And so, I think it allows us to differentiate between the things that are next to impossible to predict, right? Short-term market movements versus some things that I think, as professionals in what we do, we have a little bit more clarity on what's coming down the road.
Yeah, and it's not like we're static. It's not like we never do anything. We're constantly trying to anticipate what might happen based upon what's happening. That's different than reacting to what's happening. So as certain areas of the market become overpriced, we will potentially sell some of those investments and buy things that are cheaper. So we're looking for value all the time. Interest rates now are very, very low. This is a good time for long-term investors to make money being invested, so we want to stay in the game. But again, we have to shift periodically what we're investing in as things are happening around us, as opportunities arise.
And I think we need to also remind investors that shifting takes place sometimes even without our intervention, right? That there's a very big difference between just buying a passive investment index. Yes, you can do that cheaply. Yes, you can get broad stock market or bond market exposure, but there's also a role that active management plays.
Yeah, and there is. And we like indexes, as you indicated, for keeping track. Where are you relative to something? Indexes are great for tracking. They're also cheap, as you indicated. There's no cheaper way to buy the market than to buy a market index fund. But for my money, for my investments, for my clients' investments, and for our firm, we prefer to have someone watching your money all the time and specializing perhaps in growth stocks or in value stocks or in reacting as we currently are to changes brought about by the pandemic, buying things that perhaps aren't doing as well today, but will be doing better later as vaccines become available and as hopefully the pandemic subsides.
Well, and I think that's the key, right? That you can avoid having to time the market, A, by having a plan, but B, trusting that the people that you're working with also have a plan and that you understand what that plan is. So if it's broad market indexes, you know the role they play. If it's active management, you know that there's active managers who are going to be riskier and there's active managers who are going to be less risky. You know, understanding that as you look at a statement, there's going to be different pieces moving in different directions, and there's a reason for that.
Yeah, and investing very much is a team sport, the way we play it. We work with our clients to develop portfolios that are absolutely as best as they can possibly be for our clients' current needs for safety, stability, income, and growth. And then we select managers that are appropriate for those clients so that they are exposed to the right areas of the market that are appropriate for their personal goals and objectives and their personal needs and their personal risk tolerance. If someone gets scared when the market is going to sell off, we don't want to be as aggressive with them as with someone who really wants to shoot the lights out and has a proven ability to stay in the market as it gets volatile. So,
and maybe to bring it all together, Art, when you talk about those various pieces, when you talk about the various members of the team, right, understanding that each of them plays their part, that each of them ultimately needs to understand what the strategy is, what the long-term plan is, but then also understanding that all of them along the way are taking action. And so when you feel the need to respond, right, when the idea that maybe we should sell now because things are a little uncertain, when that pops into your head, to remember that you're not missing out on anything. And I think that fear of missing out is pretty significant. It's a pretty strong battle for investors to want to respond and to understand that, okay, maybe I don't need to respond because other people are doing it for me right now.
Yeah, we want to have an answer for everything and anything, even though we don't know when anything in particular is going to happen. And so we want our clients to have confidence that we have selected managers that are able to appropriately respond to those changes. And so call us if you have a question and we'll address those concerns and make sure that we have covered the bases, make sure we do have the right positions to get through what's going on and to, do well when things change.
Art, thank you so much.
My pleasure.
And now here's Bob with a few closing remarks.
Thank you for watching the Landaas Company 2020 Investment Seminar. As always, call your advisor with any questions or concerns that you might have. We appreciate your continued trust and confidence in our firm. Hopefully we'll see you in person next year. Thank you.